Sharma, Vice Chairman and Joint Managing Director at First Global, is joining in. Shankar, allow me, first of all, season's greetings to you and wish you a very, very happy new year. It's been a phenomenal ride, right, the last 12 months. And allow me to go back to one of your tweets. Actually, it's a tweet from First Global, which Rima pulled out. And allow me to state this, and maybe our viewers can look at it. Bear markets teach you how to gain discipline. Bull markets teach you how to lose it. So as we speak on the 1st of January, 2021, where are we in this cycle?
So I heartily reciprocate the season's greetings, and I wish all of you at CNBC and all the viewers watching the show, a wonderful 2021. And I do hope that we don't go back to the March kind of situation, not just from a market perspective, but from a overall economy and health perspective, what we saw in the month of March and subsequently as well, because we must not forget that this year, last year was a very, very painful year for a very, very large percentage of global population, Indian population. So let's also spare a thought for them. Coming to your question, India, if you talk India itself, so India was up, I think, about 14-15% for the year in 2020. And most interestingly, I think almost all the gains came in October, November, and December. So if you looked at India till September 30th, okay, India was around flat for the year, okay, for the entire year. From January till September, it was a very late sprint, which India started from October, continued in November, and December was also a decent month, I think 7-8% up, which has propelled India to finishing the year with a 15% calendar year gain, which again, understand this. If you see 2020, 2019, 2018 was a down year for India. I think it was down maybe 3 or 4%. 2019 was, I think, about 6 or 7% up, which was very, very low compared to the rest of the world, because the rest of the world had a massive bull market in 2019. 2020 is where India, especially in the last quarter, has started to show signs of life. And I think that's a very good sign. I think that augurs well for this year. I think this year, India is cyclically due for a good year because it has had 3 fairly tepid years, 2018, 2019, and 2020 also in context of some other global markets. India has done not a great deal because some other markets have done phenomenally well, like Vietnam is up nearly 50%. So India is cyclically due for a good 2021, and I think all the factors are aligned. Most importantly, low interest rates, because we have seen interest rates of this kind only back in 2004, and we know what happened subsequently. I'm not making a call that we'll compound 50% like we did in 2004, 5, 6, 7. But we will take a 15% compounding from here on. I think the stage is set for a very decent 2021.
While it sounds wonderful to hear you say that 2021 cyclically should be a good year for India and for the Indian market, let me ask you this. Is too much consensus a risk? In your investing career, and it's a long, wonderful one at that, when is the last time you remember the market being in almost uniform consensus? It's like there's no bear out there. No one's talking of risks. Everyone's talking of the positives. And I wonder if that should make us a little scared?
Yes, it should. It should scare us. And, I can only tell you what the way we are looking at it. And I personally think as well that, when there is such big consensus, big agreement on where the markets are going to go, at least even if it's temporary, markets can give you a big jolt. And I think, you could be due for that. It could happen as early as next week, or it could happen in the month of January sometime. But I just think, a 60-70% rally from the lows that we have seen, and not just India, but practically most markets, did that from the March lows. I think it's just unsustainable to imagine that we'll get another 20% on top of this without any correction whatsoever. So, we should, as investors, and more importantly, as prudent investors, be approaching this market with optimism. But as I always say, when you're going out and there is a forecast for some rain, take a raincoat or an umbrella along. You may not need it, but it doesn't mean that you were foolish if you took it out with yourself. So I think you should be prepared for a surprisingly let's say vicious cut, even if temporary. But I don't think it will last much. I don't think it can really derail what we are seeing right now. And that I think comes out of basically one simple thing. When you have global interest rates, Indian interest rates, down to these levels, I mean, it simply is that the equity end is at the other end of the seesaw. So equities go up when rates go down. I mean, beyond every analysis you want to see, that underpins uh, you know, core analysis, right? And that's exactly where we are right now. I mean, I don't see interest rates going up in India. I don't see them going up globally. And if that doesn't happen, then equity markets are only one way to go.
I go back to a conversation that we had a few weeks back, I think it was end November or early December, and we were asking you whether you see enough signs of this whole cyclical play finally becoming a reality after maybe a decade. Now, a couple more weeks down, more commentaries from companies, etc. later. What do you say? Are you any more convinced?
So, um, again, from a tactical perspective, we are playing the cyclical. So we have some autos. We have had a very good run on the metal plays. In India, you have a limited choice. You have JSW, Tata Steel, and Hindalco, and all that, and we have played all of them, and they've done very well. We have played cement as well. We have not played the banks because we have nothing against the banks. I've been a bank in my life, so it's just that RBI's commentary on the banks, credit quality, if when the moratorium goes, is again a cause for concern. So you can play cyclicals without taking excessive risk, and we are playing that without taking a lot of leverage or leverage plays. So I think autos, cement, steel. If you are brave, you want to go and buy realty. I mean, by all means do that. But I mean, that's not a recommendation again. But many people tell me that real estate sales are doing very well in India, etc. I mean, I have no ways of verifying that and whether that is sustainable or it's just a pent-up demand getting exhausted, in a matter of a couple of months. But there are safer areas where you are buying with some, just before I came on, you were mentioning Escorts, which is again a company we own. It's done very well for us because rural Indian, side of the demand, remains very, very robust based on all the data and conversations that we have. So there are ways to play the recovery trade. And remember, I don't think it's as if you have to play only these or that IT and pharma, which were stellar performers last year in 2020. In fact, if you see the data for 2020, the most interesting thing is that with all the sound and fury, banks were overall. The Nifty Bank, I think, is still minus 2% for the year, last year. While IT and pharma were up 30, 40, 50, 60%, something massively up. I don't think you need to go away from that. You can simply trim them and go into some of the recovery plays that you mentioned and that I also mentioned. And I think when you're buying things like the metal plays, you're buying them with a big global boom, in commodity prices. Again, you're buying it with the confidence that the weak dollar trade is propelling commodities higher, and therefore you're on a very sound footing when you're buying a local Indian company like JSW or a Tata Steel or a Hindalco. So there are ways to play the recovery trade, there are ways to play cyclicals, and the way we have played it is exactly what I just mentioned, without getting into relatively more, the riskier end, which is the leveraged financials, banks and NBFCs.
I wanted to get your thoughts on the primary markets. Now, 2020 has seen an IPO boom, and you had once tweeted, sometimes having too much experience in the market is a liability because, you remember the previous IPO frenzies and you go back in time and talk about 96, 99, 2007, Reliance Power. Given the kind of subscription we've seen, Burger King, Mrs. Bector, is it time to get a bit cautious? Is there just way too much money, and when that tap just closes or even tightens a tad bit, we're in for trouble?
Yeah, so I think all these, if you go and analyze markets from all the big boxes, okay, of a speculative fur frenzy, feeding frenzy, I think all the boxes are ticked. But the beauty or the tragedy of markets is that you can tick all the boxes and yet get everything wrong. So because you can do all the research, all the analysis, all the thinking, and you'll end up with absolutely a wrong perspective on markets or on the stock. And while all the boxes are ticked right now, I am loath to say that this will cause the end of, let's say, even a cyclical bull market. I think what it might cause is a big shakedown, which can be sudden, brutal, it can surprise us. But I really do not think you can call the end of a bull market just yet. I think, particularly for countries like India and emerging markets overall, which have had very poor last several years, I think they're just coming into their own. And I think you can continue with the speculative frenzy for quite a while before things become more sane. So it's not as if just because two IPOs or five IPOs got massive subscriptions and great listings means that it's the end of the bull market. It's a sign of caution, no doubt about it, and I'm the first person to say that. But I don't think it marks the end to the current bull market because India has not had a bull market. I mean, if you look at multiple year returns, you are still very, very low. You're still like 5-6% compounding, which is pathetic in a country which is beset with high interest rates. What with 5-6% in equity returns? So I don't think you've had a speculative frenzy on the stock market side anyway. I think it's building up. It can go on a lot longer before things, go south. So yes, be cautious, but I think, while it is rational that all boxes are being ticked, I don't think it just necessarily means that you will get a bear market coming around because we have been in a bear market for a pretty long period of time.
Okay, good to hear. Good to hear the optimism, especially today, Shankar. So as we wind this up, what do you think is going to be the big idea of 2021 or the big thing? I mean, people are talking about Atmanirbhar, PLI, and we spoke about this red hot QSR space, return of consumption. What will it be, 2021?
In my view, 2021 is going to be the year in which we will see investors who shunned emerging markets for the last 10 years and worked very well come back with a vengeance into emerging markets. And again, I'm saying this, please, the takeaway from this should be that India will benefit because there will be a global shift into emerging markets. It's already visible. I think it will accelerate in 2021. And within the category of emerging markets, India has been a relative tepid performer. So I think there is a lot of headroom left for India to perform in 2021 and come up the ranks. Because remember, before you go, last year Brazil was up 35%. Last year, 2019. Sorry, not 2020. 2019 Brazil was 35%. Russia was 48%. India was up only 8% 2019. India has huge, headroom for playing a catch-up rally relative to its emerging markets peers. China has had a terrific 2020. So I think the theme is going to be the laggards in global markets, in EM will have a very good 2020.
Shankar, thank you very much for joining in. Have a happy, healthy and fulfilling 21 for you, your family and everyone at First Global.
Joining us now, founder of Abacus Asset Management. Sunil, thanks a lot for joining us. And, as we've, usher in the new decade, first of all, season's greetings and Happy New Year to you, your family and your team. Tell us, what's the best investment thesis right now as we step into 2021?
Thanks for having me. Anuj, it's always a pleasure to be on your channel. And wishes to you, everyone at CNBC TV 18 and all the viewers. So, we head into 2021 and you have been, sort of cribbing last few days. We are the only market which is open. But I think looking at the market opening today, it's not a bad day. I think we have started on a good positive note. I think from our side, the one, I would say the biggest, view we would give is it's still time to be long equity. And we still believe that equity, even in 2021, would make decent returns. So, I would start with that.
Okay, so Sunil, greetings of the day of the season to you and all your near and dear ones, and of course your team at Abacus. We want to hear more if it's going to be a good year, then in what shape and form, and how do we position for it? How do we gear up for it?
So obviously, Surbhi, from a period of maybe doom and scare, which we were in March and April, the year has ended up pretty optimistically. I think the Nifty on an overall basis has been up some 14-15% for calendar year 2020. The mid and small cap, after 3 years of underperformance, have finally risen more than the Nifty, albeit very small, 5-6%. However, as we move forward, there are obviously apprehensions because of the rapid rise in the stock prices. But having said that, from the bottom, yes, stocks have moved up maybe 70, 80, 100% also. But on a one-year basis, we are still maybe 15%, which is not a very big rise. And as we move forward, there is a lot of tailwinds also quite visible. So the regular tailwinds of earnings growth, which is clearly for the first time in maybe 5-6 years, coming in better than what the analyst expected, and I think that is the key driver. And the other biggest tailwind has been all the money printing which has been done globally. I think that liquidity is going to not only drive flows into the market, but it also aids the businesses because suddenly you find capital is available in plenty, risk capital is available in plenty, and cost of capital has come down, which sort of ignites demand as well as also leads to a higher profit because interest costs for corporates go down. So I think this is a good sort of a situation to be in. I think the only note of caution would be that money making has become too easy last 3-4 months. And I think 2021 to that extent might be a little different, where you'll have to work to make that returns. It's not that, even if you made mistake, you made 50% return. That was the case last 4-5 months. I think that will change as we move forward. So, थोड़ा काम करना पड़ेगा.
थोड़ा काम करना पड़ेगा. Actually, yeah, I mean, I was not cribbing, Sunil. I was just, stating, what looked logical. Anyway, next 2 years you won't hear me cribbing because next 2 years it's weekend on 1st January. So
it's a collective crib, if you want to call it that, Sunil. Yeah. We are completely in sync with Anuj on this one.
Then I join you in that cribbing.
No. Okay. So now Sunil, you know what? Money making is never easy, right? It may sound easy. Of course, you would know as a fund manager, having spent so many years. Now let's talk about some big sectors and some big moves. Today, Sunil, the news that we have the GST collection at 1.15 lakh crore. The auto sales numbers are looking quite stunning once again. And now, you can no longer say perhaps that it was just pent up demand, right? Or can you? Your views on the auto sector?
So again, I come back to my earlier point. So obviously, this pent up demand maybe lasted till October, November. I think what happens is, we are human beings, and if we feel good about the future, we end up sort of preponing or even spending money. I think that has been the case. And the other thing is, as I again mentioned earlier, the interest costs have come down. So your EMIs payment for particularly the passenger vehicle side, whether it be four-wheeler or two-wheeler, have come down by almost 20-25%, which makes it sort of more affordable for people to acquire a vehicle. And obviously this personal mobility, because of the scare of pandemic, will continue for some time. The heartening part is that the commercial vehicle segment is now starting to come back on track. I think that leads us to believe that finally, even on the economy side, it's not only the consumption driven economy, but even on the capex side, things have started to move up. And maybe it's a function of commodities doing well, which are big guzzlers of so-called commercial vehicles for movement. Maybe even some of the other sort of sectors like, we have generally the businesses doing well. So logistics and all have started to move up. And the kind of ordering which EPC companies have been sort of announcing, that clearly shows that even the government capex is finally now looking likely.
Sunil, also, a lot of people are looking at playing the recovery through cyclical. So specifically, what part of cyclicals should one concentrate on? Because it's a very wide basket otherwise, if you start looking at, EPC, as you said, some of these other sectors as well.
So Surbhi, again, we are in a period of, ample liquidity, at least for the next 3-4 years. I don't think anyone has a view that the central bank will start to tighten before 2-3 years. And this liquidity is going to last. It is very cheap. Interest rates below 1%, almost 65% of the bonds in the world trade at below 1% interest rates. It used to be only 20% when we started 2020. So, you have cheap liquidity. Risk capital is available in plenty. You see the kind of equity deals which are happening. Clearly, there is ample capital. And as we move forward, the last few years, what was happening is that, debt was considered to be taboo. So as a result of which, no company has expanded capacity. Now, as we move forward, you need your steel, you need your cement, you need all your basic industries, And the companies which have capacity are obviously going to mint money because pricing is going to be in their favor. There is demand which is, at least for the next 2-3 years, going to be higher than the supply. And therefore, every company which has resources is going to make, I would say, more than the normal profit. And in this kind of a scenario, I think integrated metal players, integrated steel players, I would say even integrated chemical players or, to some extent cement, because cement still there is a lot of ample capacity. I think all of them are going to benefit.
Sunil, now I know you're not going to talk stocks, but come on, it is the 1st of Jan of brand new year. So give us a hint, some clues on the hot theme or the micro sector to look at.
I think, Surbhi, our funds are, the portfolio is available in public, but, for the benefit of the viewers, I still like the digital theme. I'm a traditional investor and normally I don't like very high PE companies. But this is a theme which is going to last for a long period of time. And, we are all exposed to it on a minute-to-minute basis. The way we work, the way we study, the way we consume, the way we entertain ourselves, the way we shop is all completely changed. So I think anything to do with digital, good promoters, market leadership, potential of growing maybe, 50, 100 times over the next 10, 15 years. I think those companies will be under always the investor radar. Unfortunately, in India, most of these companies are on the unlisted side. But you just check out the companies which are on the listed side. They are just going through the roof because of scarcity, obviously, but also because of the huge moat they have. There is an indirect way of playing it through the IT because it has a similar moat, except that the growth is not going to be as sharp. But we still like the IT space, and spending on technology is increasing globally. And I think the top line as well as the bottom line performance of these companies will surprise. We like domestic branded companies on the second tier, third tier names. There are a lot of companies which have niche brands in India. And, because the whole market was just focusing on a few large companies over the last 3-4 years, these companies, ended up being available at like 15-18p with an ROC of 20-25% and good brands. And we are trying to see if we can buy into a few of them. But that is one good segment. On the metal front, frankly, you can't take a 5-year view. But there are some companies with an integrated model, which I touched upon earlier, which can be looked at from a couple of years point of view. And pharma is going to be a sector which you cannot be ignored. I would, at any time, prefer good pharma companies at 20-25p rather than buy FMCG companies at 50-60p.
What would be the key risks to monitor in 2021? Because right now there's a bit of a euphoria. Everything looks good. But the market is also at all-time high and also at all-time high valuation.
So, Anuj, the cliched answer would be the strain of COVID or some new strain coming in, that frankly no one knows. But I would say from my side, if money making continues to be as easy as it has been the last 3-4 months, maybe over the next 2-3 months also, I think then it would become really worrying. Right now, despite the last 3-4 months of very good markets, investors generally are under-invested in the equity markets. But if this continues for 2-3 months more, then maybe that changes. And normally the first quarter is a quarter to watch out for. We have had multiple occasions when things blow out in January to March quarter, and that's not from a fundamental perspective, but from a technical perspective. So I think what we are watching is whether this easy money making continues for a long period of time. Then things will really be worrying from a market perspective. I think otherwise we are in a good spot. Finally, I would say that what we needed to do as a country, we are doing. We are focusing on manufacturing. And if we focus on manufacturing, then jobs will automatically be created. Good thing for us is interest rates have come down, because as a country, the bigger issue for us has been high power cost and high interest cost. And both of them are now falling in place, which will make Indian manufacturing also competitive.
Okay, well, those are wise words, and words that our viewers will, of course, benefit from. Thank you very much, Sunil, for joining in today. And once again, greetings for a great 2021 to you.